In a hunt for funds to help pay for the Senate's bipartisan infrastructure package, U.S. lawmakers have turned to the cryptocurrency industry as a potential source of tax revenue and are proposing tougher scrutiny of digital transactions. The Senate released the latest version of the bipartisan infrastructure bill on August 1, 2021. Notably included is increased information reporting for cryptocurrency exchanges or brokers of cryptocurrency transactions. Earlier this year, the Biden administration outlined a variety of policy priorities and how they could be used to raise revenue, including bringing the crypto industry under more IRS scrutiny. The administration initially proposed requirements for reporting cryptocurrency transactions as part of its broader initiative to narrow the $7 trillion tax gap. In the past, IRS Commissioner Charles Rettig has repeatedly asked lawmakers for more power to improve tax compliance in the cryptocurrency industry, where many market participants are unaware of their obligations or are outright cheating. For years, the IRS has been warning taxpayers to report cryptocurrency transactions on their tax returns. The IRS has started collecting vast amounts of data on blockchain transactions, has subpoenaed crypto exchanges, and worked on coordinating enforcement with foreign governments. Last year, the IRS added a yes or no question to the front page of the 1040 income tax form, asking whether filers had sold or exchanged virtual currencies. The jurisdiction of U.S. law enforcement only reaches so far, and crypto traders who prize secrecy could flee to offshore exchanges or take other measures to avoid being spotted by the IRS. To help fund the $1 trillion bipartisan infrastructure bill, the Senate has proposed a provision that would impose stricter rules on how digital assets are taxed. In the latest version of the bill, the provision would require crypto brokers to report specific information about crypto transactions, like price points from when users bought in and sold. This would be in addition to reporting transactions of more than $10,000 to the IRS, which is already mandated. The current bill is estimated to raise over $28 billion to fund infrastructure projects over the next decade. If passed, the proposed law would require cryptocurrency exchanges, defined as any person who is responsible for regularly providing any service effectuating transfers of digital assets on behalf of another person, to file an information return reporting the transaction. The proposed legislation does not expressly say anything about penalties other than to state that Section 6724 of the Internal Revenue Code is amended to include digital assets in an information return, subject to penalty. The proposed legislation would be effective 2023, giving exchanges a year and a half to get ready to meet the requirements. On August 4, 2021, Senators Ron Wyden of Oregon, Patrick Toomey of Pennsylvania, and Cynthia Lummis of Wyoming filed an amendment that will exclude crypto miners and software developers from the tax reporting requirements in the bill. Senators say the current bill's definition of a broker is too broad and argue that reporting obligations should apply only to individuals conducting transactions on exchanges where digital assets are bought, sold, and traded. As per unnamed administration official, White House is pushing back against the proposed changes. The crypto regulation within the infrastructure bill will primarily impact exchanges, not individual investors. Exchanges will need to undertake significant efforts to comply with the reporting regime. Investors, on the other hand, won't have to do anything. But under the new law, all of the information will now be sent to the IRS when an investor sells one cryptocurrency. When a law regarding tax reporting requirements is passed, the IRS then writes the law into the tax code. The provision in this bill is more to establish Congress's intent rather than lay out specific rules. This bill will probably be the first step of further regulation of cryptocurrency. Right now it is not clear what will happen with crypto stored in cold storage, wallets not on exchanges, so-called self-custody. It is difficult to trace and even more difficult to devise an information reporting scheme that would encompass such an asset. The potential for more federal scrutiny of crypto transactions is rattling nerves in the nascent financial technology industry, which has so far escaped the kind of rigorous oversight applied to traditional financial services. Cryptocurrency exchanges and others in the industry have raised concerns that the U.S. Senate is rushing the rules into effect without consulting them first. If the proposed legislation is enacted as currently written, cryptocurrency exchanges will need to work hard to ensure they are meeting the rigorous information reporting requirements to avoid information reporting penalties. And cryptocurrency holders will need to be even more vigilant in ensuring their cryptocurrency transactions are correctly reported. All this isn't necessarily a bad thing for law-abiding investors in digital assets if they end up with clearer rules and easier to understand annual statements from crypto firms. While exchanges and fintech firms that deal in digital currencies may have to spend money upgrading reporting and compliance systems, it will improve customer service. The new rules will help legitimize the crypto ecosystem and foster international growth. But the provision also underscores the realization in Washington that the $2 trillion industry is here to stay and offers a new opportunity to generate federal tax revenue.